Welcome, New Zealand Funds. Taking your time out today to come and talk to us a little bit about wealth after work and give us a little bit of an update on financial markets. So, thank you very much, Reid.
Thanks for the introduction. Thanks, Andrew, and to all the team. Katie, thank you for putting this on. It's nice. We've done this a few times now, and it's good to have a few people coming back to get a bit of an update of such. But thanks, the team, for putting it on. It's a lot of fun. We enjoy it, and we hope that you'll take away some really good sort of key points, I guess, from this presentation. Well, we've got Mark Brooks along. He's our Chief Investment Officer. We're pleased to be able to bring him in to talk a little bit to a market update of sorts, and then Wendy Shan, who I work quite closely with. She's another advisor as well, and we want this ideally to be a pretty relaxed session. By all means, chuck a few purely questions at us from time to time. It's important that you take lots from this, and we'll also be sticking around afterwards. So if you're a little bit shy, ask a question. We'll be hoovering up the canapes in the Coronas later on, so you're welcome to come over and chat with us afterwards. But I guess I'll start off with a bit about NZ Fund, which I haven't actually included in this, apparently. Yes, so NZ Funds have been in business for almost 36 years now, providing sort of wealth advice and investment solutions for Kiwis. We're a 100% Kiwi-owned and operated firm, and we are stretched across about 7 offices across New Zealand. We look after a large amount of money for about 30,000 Kiwis. So importantly, these are Kiwis these are kids with their very first KiwiSaver accounts, all the way through to those that are working and paying down a big mortgage, and then those who are starting to think more about retirement and whether or not they're kind of getting their ducks in a row and they're ready for that, even through to clients who are then retired and then are starting to think about how do they best use their nest egg to fund their golden years. So we look after clients across a broad spectrum, and we enjoy it. So naturally, it starts with a bit of a disclaimer.
The lawyers are always involved somewhere.
Yeah, this requires sign off every time. The advice today is general in nature, is general in nature, so can't be construed as specific personalized advice. And these, if we talk about any investments, then we encourage you to refer to our product disclosure statements, which I'm sure you'll be delighted to go through. Here's a bit of an itinerary. Mark will cover an investment update shortly with a few slides. Why planning for retirement is important. It sounds like a pretty obvious question, but it's not one that we often necessarily turn our minds to. What value does financial advice play? How to make simple investment decisions, and then lastly, we'll take you through what we call Wealth Plan, which is our financial planning software, and helps you create a bit more of a picture for a client. So, without further ado, Mark.
My turn.
Yeah, take it away. I think. Well, there you go.
Cool. Thank you, Reid. Afternoon, everyone. Sort of jump straight into markets and investments, but the problem doing that is we never really explain what the actual role of fund managers is. And in that sense, ultimately our goal and our role is generally to move people out of cash, because cash is the default asset that you work, goes in the bank account, and it sits there. And there's nothing wrong with that, but that's kind of why I start with this chart. If it's sitting in the bank, even at the moment earning 5% or so, that's quite a good number. But by the time it's sort of post-tax, that comes back to 4% or even sort of 3 and change, depending on your tax rate. That's a difficult way to build wealth. Whereas, think about how New Zealanders have typically built wealth. Generally, it's by investing in property, right? And they've done that by owning houses over a very long period of time. But what have they actually done by doing it? what they've taken advantage of is not an asset that's generating a 3 or 4% return. It's an asset that's generating a 8, 9% return. And the power of that is the idea of compounding. So if you take 7% return, we'll go back a little bit, a 7% return, over 10 years, your money will double. 100 becomes 200. And the key is over longer periods of time, 100 becomes 200 over the first 10 years, the next 10, 200 becomes 400. So you've gone from 100 to 400, and 400 becomes 800. So ultimately, that's basically our role. Yeah, it is encouraging people to use financial markets. Most New Zealanders have some form of property themselves. Encouraging New Zealanders to use their savings, use their KiwiSaver, to use financial markets, to use that power of doubling. And the example we've got here, the challenge, which I'll go into in a second, but the example we've got here is our New Zealand and Australian share portfolio. It's one of the longer ones we've had within our business, so that's why we use it. But starting back in 1992, and it's useful to think about that point in time. It was a pretty ugly period of time, people remember back to. And then you had, at that point, New Zealand was in a proper recession. We're in a recession now, but we were in sort of a proper -4, -5% type number. Unemployment was, I think at the start of 92, 9%. It was going to 11.5. Sorry, 7% was going to 11.5. You had a little thing called Ruth and her mother of all budgets, where government spending got massively cut. And then you had a few wars around the place, the first Iran-Iraq war. So it wasn't a great time in the world. But interestingly enough, sort of the red dots there, I'm standing in the wrong place, but the red dot from 92 to 96, that was a doubling. Now, that was actually much faster than we'd usually expect. Often that sort of takes, on average, sort of around about 10 years. The next one happened over a more traditional 10-year period. Then you had this little thing here in the middle, which, this does work actually, for the GFC. So actually, you got a period which took much longer, closer to 15 years. Markets were much more difficult. And we don't know quite where we are yet in terms of the next one. But ultimately, that's the power of compounding, and that's what we're trying to do with our clients' money. Now, I'm the engineer, I suppose, is probably the best way to put it. We sort of do the nuts and bolts. Really the role is Wendy and Reid in terms of working out what is right for your age and stage. Yeah. Some people being heavily invested in shares is right. As you get further through life, you want to change habits. But broadly, that's what we're trying to do is encourage people. Cash is useful. You've got to have some cash, but encourage people to have cash. And I'll go back to this first one. How do we do it? Ultimately, the left-hand side is whether you use us, ANZ, Milford, Fisher Funds, anybody else will generally be comprised of the left, cash and bonds, shares and managers of shares, and by the fact that we're in New Zealand and a small country, some currency exposure. That'll be, and that's about 80 to 90% of what we do, and it'll be exactly the same for others, anywhere you go. What makes us a little different is we are big users of things like futures, not so much options, but more futures. When I sort of say futures, most people go, that's derivatives, it's a bit odd. But essentially what we use those for is, actually I'll go back a step. If anybody's bought a house here, they will have traded a future, because you agree a price when you buy that house, but you don't pay for it then and there. You pay for it 3 months or 6 weeks later. So all you've done is create a financial contract that you settle in 3 months' time or 6 weeks' time. It's exactly what we're doing with a financial future in the markets. We might, if the S&P, the big US share market index, is trading at 5,000 today, we'd agree to buy it at 5,000, and 3 months' time, we'd settle up with whatever it is at that point versus 5,000. It's just the difference. It's a very easy way for us to turn the volume up and turn the volume down versus buying and selling 500 different companies and the transaction costs that come from that. Probably won't go into this too much, but we also do use a number of different, what we call downside scenarios, because the world has some challenges out there and always does. So we just want to make sure that we have some strategies in place that, we are relatively, I wouldn't say confident, we are willing to position portfolios for where we think the road is going. But every once in a while, you get a COVID-style event where the road goes the other way. And it gives us the ability to at least have some cushion in that situation. But mainly what I wanted to talk about today was kind of how we see the world. And so let's turn that off. Sorry. This is a pretty ugly chart. There's way too much here. But broadly, I suppose the theme for today is kind of summed up by these two. The blue line here is New Zealand sort of going sideways, and this goes back to basically the New Zealand market back to the beginning of 2022. And the lighter blue and the black one is essentially the US and the world markets, and they've been going up really for like almost 2 years now. So quite different. And in many respects, that certainly in New Zealand, it probably doesn't come as a great surprise. The world out there is really challenging in terms of where interest rates are and in terms of government spending, things like that. And if you think about the types of shares that are listed here, often, the majority of those are quite dependent on what's happening in the economy. Meridian Energy is not going to go up 20%, particularly because if activity is slow, GDP is slow. Whereas you go to the US, these days, the reality is a lot of that is the technology space. Names like the Microsofts and the Googles that we use every day, and they do have an ability at different points in time to go up 20% when the economy is not necessarily doing that. So we've seen quite different performance, I think, across the different areas. But that wasn't probably the main theme, I suppose, we're seeing out there. Can probably be best described as a return to normality. Doesn't feel like it, especially here in New Zealand, and New Zealand's starting to diverge from everybody else. But if you think about what happened in COVID, pretty much all of the Western world locked down at the same time, give or take. Central banks all cut interest rates at about the same time. Governments started spending, which was right, but it all happened essentially about the same time. And then you had the supply chain issues. It wasn't just a New Zealand issue, that was a global issue. You had that demand where people were at home, started buying goods, they couldn't buy services. It was all very similar. And surprise, surprise, you actually got very similar levels of inflation. In some respects, New Zealand, or possibly the fact that we only counted every quarter versus monthly, but New Zealand peaked here at about 7%, whereas the US was about 9%. I think the US is the black one, and Europe, because they had gas issues in terms of massive energy costs with the Russia-Ukraine war, they were well over 11%. So they really did have a cost of living crisis from that point of view. But what it is interesting, we think, is that actually, even though inflation's proving that it's taking some time to come under control, and it's not as fast as the Reserve Bank would like, that's a pretty symmetric chart. So that does suggest things are healing generally. New Zealand's got some, as I said, it's got some things that are different here versus the rest of the world, but generally we've got a process where that is healing. And again, if you think about the supply chain stuff, most goods you can get pretty easily now. There's not that delay that there was back in COVID. So we are getting back to a more normal situation. I'll kind of skip that one. So, yeah, in terms of, from our point of view, if we think about where the economies are, broadly they're starting to return to normality, and probably, yeah, what that does mean, New Zealand maybe a little later, but it might actually be a bit earlier, as it turns out. Cash interest rates, the OCR from the Reserve Bank, is going to come down. With here, probably more so because growth is so slow that actually inflation will start to come down. But generally, as part of that easing process, we'd expect interest rates to come down. And if we think about those, the two primary assets outside of cash are bonds, which are really us lending to corporates, buying, essentially lending money to Spark or to Meridian Energy or something like that via a bond. And if we think about the valuation of those, this is a chart of US, what they call investment grade companies. So that would be like a Walmart or I don't know if you're at Packard or something like that, or even McDonald's, or those sort of well-known brand names. Generally, at the moment, we can essentially lend to them and they'll pay us broadly about 5%, which is not vastly different to cash.
Yes.
But the key is those are typically for much longer periods. Essentially, we get to lock in the money for about 5 or 6 years. So, whereas, there's a fair chance cash rates are going to move down. Again, maybe not as quickly as many expected, but move lower over the next year, I would think. And if we sort of stand back and say, well, what does that compare to what we've seen previously? Prior to, during that COVID period, we were getting paid about 2%, so it wasn't particularly interesting. If we look back through time, this chart goes back essentially 20 years, and excluding that GFC point in 2008, which pretty much nobody wanted anything. Everybody needed cash and nothing else at that point. If you kind of exclude that, we're about as high as we've been in 20 years. So to us, that kind of says that as an investment idea for the more defensive, what we call the more defensive part of the portfolios, that's a good place to be. That works. In terms of shares, actually, we've got a New Zealand one here. Yeah, got that out.
Yeah, that was it.
No, it was probably me. In terms of shares, for most people, they kind of look at shares and go, well, prices go up, prices go down. How do you work it out? The way in which we think about it, it's about saying, well, how many times earnings are we paying? So, what do we got here? There's a, work out what that business was across the road, but
Pharmacy, is it?
It might be pharmacy. But say that pharmacy earns $100,000 a year, and we buy it for $1 million for the whole business. What are you doing? You're basically buying it for 10 times earnings. And on that basis, if we did that and it earned that $100,000 every year, we repay that investment in 10 years, we'd earn a 10% return. Now, if you go and buy a McDonald's or something, it's a vastly bigger business. It's a lot more mature, and because you have the luxury of the share markets of buying and selling at a fairly instantaneous event, because trying to sell a pharmacy could take you a week, could take you a year, maybe, to sell a business. They tend to trade on much higher multiples, and generally somewhere between 15 and 20 times. So that's sort of, I suppose at its very simplest, that's sort of you're looking at 5 to 7% type numbers as a pure capital number. And if we look at where those numbers are, during that COVID, generally on average they trade about 17 times. During COVID, they got really, really expensive. A bit like the fact that basically everybody was chasing a whole lot of goods and they were at home. not doing much, so a lot of people bought shares, and especially the US. So things got really expensive. They've come back. They've got a little more expensive more recently. And do we have? We don't have vacancy 7. We should have put that one in, shouldn't we? Doesn't matter. In terms of the broader market, there's a group called the Magnificent Seven, which is essentially the really big technology companies. So your Microsofts, your Amazons, NVIDIA, who make these AI chips and graphical chips, and Facebook, etc. They have made the market a bit more expensive relative to history, but if we take those names out, I think there's a very good reason for those being a bit more expensive because they're growing really quickly. Actually, markets are trading at very normal levels. So, yeah, that's a slightly abridged version to say, well, actually a lot of what we see out there seems like things are getting back towards normal, not necessarily perfect, but back towards normal. And actually, in terms of valuations, be it sort of more defensive bonds or shares, they're not wildly away from where they are typically. So that sort of says to us, yeah, the playing field is about right. The first question that usually comes, well, but what about the wars out there, or what about the elections, and especially the elections in the US? Before I touch on the elections, though, I think one is really interesting here for the New Zealand situation, because New Zealand's pretty depressed at the moment. You know, we've got high interest rates, government's reducing spending, and retail sales are pretty ugly, etc., etc. From one thing we find ourselves trying to remember is that financial markets, and you even can say this about the property market, think about how quickly the property market changes at times. You go from, certainly the initial reaction as COVID hit was that property would be in a bit of trouble. Property market fell a bit in some places. And then it turned on a dial quickly and hard. It just went straight up. And then it stopped pretty much overnight in terms of when it did. Markets, essentially people are forward-looking. They think, well, it's not so much what's happening now, what's going to happen next year or the year after. And share markets especially are like that. There's a whole lot of numbers there, forget about the numbers. But remember back to, I'll go like that. Think about this chart here. So here, the US share market turned in sort of October 22. Essentially, in some respects, they were a bit like we are now, I think. They were really depressed about the economy and what was happening. And in many respects, a lot of that bad news and the bad sentiment was in the price. So from October 22, if we go through and actually what we've got here is earnings in terms of the companies. And on the far left-hand side is essentially the last quarter of 2022. So that October, November, December period. That, of course, that was the earnings for that quarter. So that was reported generally about sort of late January, early February of the following of 2023. That was the bottom of actual earnings. So you can see that the market actually started to try and price that in earlier than the actual bottom market was. People were forward. And since then, one reason why the US market and many other markets have started going up is actually the numbers are generally getting greener. So corporate earnings have been better. Basically, there's people, as companies and activities got more back to normal, at natural earnings that accountant business would see with their clients and started through. The interesting next step that we are seeing now is actually in the US and especially in Europe, you're starting to see after basically 4 years with no CapEx, no sort of new spending of businesses to buy a new plant or new equipment, that's starting to happen, which becomes again a more self-fulfilling situation. So the last one, which was what I kind of jumped onto, and then talk about the previous one, was elections. And one of the most interesting things I think this year is pretty much everybody's got an election, bar us. We've already had ours. And always elections are a point of noise and concern. And especially with the chance of Trump getting, well, likelihood of Trump getting back in. The question is, what does that mean? In terms of the way in which we manage money, about a third is what we call relatively passive. So we're using things like futures to get exposure to an individual market, so the US market. In different places like New Zealand and Australia, we will select the individual shares ourselves. And then in other cases, we'll say, well, actually, it's better if we go and appoint another manager to do that. So in the US, we primarily use two managers. One's a group called Fisher International, who's based out of California. Another one's Massachusetts Financial out of Boston. Team at Fisher International have done a lot of work around the US elections. And in any given year, share markets are up and down, probably, essentially they're up about 60% of the time in any given year, and about 40% down. If we look at US elections back to the 1920s, and the nice thing about the US is it's just a 4-year cycle. The president can never call an early election. They're there for 4 years, so not like a very strict cycle. Going back to the well, this chart goes back to the 1970s, but if we go back to the 1920s in the US, 83% of the time, it's actually a positive year. So actually election years are better years, typically, than on average. And why is that? I think the story which kind of makes sense to me is that people and businesses kind of like status quo, where not a lot is changing. And what happens when you get a new government? What's the government doing now? They've got ideas. They want to do different things. So things are changing. Yeah, maybe for good, maybe for bad, but there's change. So that often that sort of, people don't get on and do things because there's a little lack of certainty because of that. Often, as you get to the end of the cycle, either governments are sort of tired, infighting. In the US case, they have these, the Senate and the congressional midterms. Usually the president loses control of those houses. So basically they can't get any new laws through at that point. So you kind of get status quo at the end of the cycle. And something we've gone back and looked at is, what is New Zealand's experience? And this is not for our election year, but for the US elections. And since the 1970s, we can't go back to the 20s, but the last 50 years, the only time the US has been positive, we haven't, it has been in 2000. So it's interesting that if, how much we follow, again, what happens in the US, even back in the 1970s when, the economies were probably much less connected. It's still, if the US has a positive experience, it suggests we will as well. 2008 clearly here says that elections aren't the be-all and end-all. That if there's bigger issues like the global financial crisis, I think that was Obama then. Even the election of Obama couldn't solve that. Again, one that looks is kind of surprising is 2016 was Trump's first time round. That actually ended up being quite a positive year for markets, sort of up 10%. So for us, that's kind of a brick in the wall that sort of says, well, a lot of what's happening out there globally is that the economy seems to be healing post-COVID. Valuations, again, be a bit like the property market here, went way up, have come down. Maybe not super cheap, but seem pretty reasonable to us. And actually, there's a couple of reasons, things like the capital spending and elections, which actually suggest it could be a better year than many sort of expect. So that's sort of generally what I had to say. Any questions on the back of that, or do I hand it over to Reid? Questions later?
Yeah.
I'll do that. Yeah.
Thanks, Mark. You want to jump onto this? So, well, explore. So now we get into the really good stuff. And hopefully this is a good opportunity for everyone to kind of, turn their heads to your own personal situation and how you're thinking about time. It's a long way off. But as a start point, why is it important? And I think the next slide, jump onto that. This is really telling. And it's what we're, what we as financial advisors are really trying to help overcome. But believe it or not, 2.8 million Kiwis, that's half the money. They think they have to work past retirement age 65 to afford their retirement. And 2.5 million don't feel they're on track to have enough money. So those are big numbers. And it's really easy to be focused on being exceptional, being a doctor, a nurse, or a business owner. But unless you turn your mind to these to retirement, it's you can't blame people for being a little bit unsure about whether they'll have to do till 70 or not. So this is something that's really forefront for our clients and to help them understand, well, have you done enough? Can you afford to retire? And what's next is that New Zealand's superannuation is really modest. I mean, we have this she'll be right attitude in many cases. We're all kind of guilty of it from time to time, but the median New Zealand income after tax is $66,000. Now, it's all well and good, but when you get to superannuation age, it's only going to cover you for $41,000 for a couple. So already there's a big gap, and you might think about your own position, your own income, and you think, well, if I'm earning $60,000 a year or $100,000 a year or more or less, and I'm only going to get 40 grand at retirement, well, how am I going to close that gap? What am I going to use to generate an income that's going to leave me with a pretty comfortable standard of living? So, I mean, not many people have thought long and hard.
Is it after tax?
That's in the hand, 41 grand for a couple after tax with the tax code at the end, so no other income. So it's maybe something you think, like, I'd do well off that, but that might, for most of us, for a lot of our clients, can live off it. But that doesn't include one-off expenses that come up and challenge people. So closing that gap is really important. What do we have next? So where do we come in? When you sort of take the lead on this one here.
Yeah. So if you own a business or a farm, you will work with Andrew and his team to form a business plan. If you're checking with them every year to make sure your business is on track. With your financial investment, it works exactly the same. You're working with a financial advisor. We get to know you, we will form a financial plan with you, and we will check in with you every year to make sure you are on track to achieve the financial goal you want to achieve. This is based on a study. It shows the value of financial advice. When a client is comparing a client who does his own DIY investment, either through shares or you have a brokerage account, buy and sell your own shares, to a client who works with a financial advisor. Usually the clients who work with an advisor will have a better outcome. And that just in a way, when you work with an advisor, you will have a more diversified portfolio. You won't have a concentrated position in one single stock or one single sector. And when market is good, it's great. Everyone just spread it out. But when the market is bad, usually if you are investing by yourself, you tend to panic. You don't know how long it's going to last for, right? It's going to be a few months or is it going to be years? So you tend to sell your stock at a really low price at the worst time possible. But when you work with an advisor, will you walk through this difficult time with you? Would you say this is only temporary? It's a temporary market volatility. Remember your long goal in the next 10, 20 years. Remember that long-term goal and stay invested. So when you work with an advisor, we provide value in situations like that to keep you, again, stay focused, stay on track to achieve the goal that we want to achieve. And how we work with you. First of all, we will take a total view of your total wealth. Say you are a property investor, you probably have 5 rental properties, then majority of your wealth is highly concentrated in New Zealand economy, in New Zealand property already. So when we think of when you invest the rest of your, say, your wealth or your cash at hand, we will take that into consideration. And for your financial portfolio, we won't expose you to too much of the property sector, New Zealand sector, because you already are highly concentrated through your rental property. And so we will look everything, have a total view, consider your property position, your business. If your business is in hospitality, then again, you are exposed to that type of risk as well. And then we will model different scenarios, shows the impact of different financial decisions. We have this tool called Wealth Plan, which we will take you through later. It shows you different, it models through different financial markets, different scenarios, what your portfolio will look like in another GFC type of event, or what your portfolio will look like in a really good market, say the bull market before GFC. So we walk through different scenarios, and then in a way it's manage your expectation as an investor. So there is no surprises, and you have a different you have a view of how your investment will look like in the next 5, 10, 20 years. So if there is another COVID sell down, you've seen this already during our modeling. So it's less likely you will be panic selling. And then after we get to know you, we work out your risk profile, we work out what your wealth is other than the investment you can invest with us. When you create an investment portfolio is tailored to you. And we, for new investors, we usually will take a year to implement the portfolio as well, because if you haven't had any prior investment experience, sometimes it can be it's uncertain. You're entering into a market you've really never seen before. So for any new investors, we usually take 1 year to trunk in, and that also reduces the risk of investing everything in one go when the market is really high. And then if again, any volatilities shortly coming after that, just it's not a very good experience as a new investor. After all that, we will review your goals and your portfolio on a yearly basis to check in with you, making sure your portfolio still stays true to your risk profile and to stay, will still continue to achieve the financial goal we want to achieve. And even though we do annual review, but me and Reid, you will have our number. So anytime you have any questions, you can reach out to us. If you hear the news, Fletcher building is not doing well, you are worried how much exposure you have, give us a call, and then we'll tell you, oh, it's not even 1%, so nothing to be worried about. So I think just having that access to your financial advisor is very important throughout that journey. And how do we optimize and invest simply? Investment can be, you need Mark Brooks. That's why Mark he's the chief investment officer. You have professionals who spend that, 20, 30 years to invest for you. But me and Reid's job is actually make it simple for you. So how to help your money last longer is to keep it diversified. So you want to have a mix of growth and income assets, which means the growth assets will help you to achieve as much capital growth as possible in the longer term. And the bonds is more like a defensive asset in your portfolio, which means if you want to go to Europe next year, you want $50,000, then you can take the money from your bond portfolio, which means you it can meet your short to medium spending needs without sacrificing the growth portfolio, which is there for the longer term. People might think, okay, so if share market overall provides the highest growth, then why don't we just invest everything into the share market? Because even though it provides the highest potential return, but it not might be suitable for everybody. You might be a very conservative investor. You are, if the drop in your market even by 1% will make you have sleepless nights. Ultimately, it's a trade-off between eating well and sleeping well. And I think me and Reid, what we do is to help you find that sweet spot, making sure you can eat well as well as sleeping well. We don't want you to lose sleepless night just because the market has dropped. And the other thing that Mark has touched on before is to consider owning fewer growth assets as you age. When we think about investment, we think about your risk profile. We also think about your time frame. For younger generation in your 30s, 40s, even 50s, that means your investment is long-term. You have 20 or 30 years to stay invested. That means if any short-term market volatilities, you have the time frame to ride it out. But when you're getting older, that means you will have more income requirements from your portfolio. So when the income requirements increases, then we want to decrease your portfolio, which means if you want to, again, withdraw 50,000 to go to Europe, then we don't want your portfolio 100% or higher percentage is actually allocated to a growth portfolio, which means you are exposing yourself to any sudden market movement if you have a material effect on the portfolio. So back to working with an advisor as you age, as you continue from working, from retirement, and throughout that journey, we make sure we keep rebalance your portfolio. It's making sure it reflects your current financial situation, current age, and again, making sure it will help you to achieve your goal along the way.
This is a place that Kiwis get unstuck a little bit. I see it from time to time with new clients that come to me. Because in the past, they've relied on things like term deposits and property assets and sometimes business assets as well, which will generate growth over the long term. But often, if it's a property, it can take time to sell it. Especially in today's market, it's a perfect example, right? Sometimes you can get rid of a house really quickly. Other times you can't. And if you're relying on that money, then that can put you in a really difficult position where you're actually borrowing money to cover the difference. The business as well can take quite a number of weeks to sell. Whereas things like cash on call, things like managed funds, those are more liquid. They can be really powerful for helping to plug a bit of a short-term cash flow gap, particularly in retirement. So always think about liquidity. What sort of assets do I have? If the worst happened and I needed to, spend a huge amount on flights to get somewhere in the world really, really quickly, would I realistically be able to come up with that money quite quickly? And so it's always important to think, more broadly, how could I access lots of money really quickly if uncertainty happened? But I think we'll just stop there. And was there any of those slides or any questions you guys had or anything we've just covered before we just jump into the very last section? Sort of talked about superannuation, talked about about liquidity and how we work with clients and thinking about what to profile. Any questions on any of that?
Talk about fees at all in that. So
well, the more you invest, the lower the fee. Essentially. So the way that we derive a fee, and it depends on what sort of service clients want. So if they want all the bells and whistles, which is called retirement plan, then we normally charge typically about 0.5% per year for full ongoing financial advice. which puts it at about half of the industry norm, which is good. And on a fund management side, so if you invest in the New Zealand and Australian share portfolio as an example, there'll be a percentage fee attached to that. But we do not charge upfront for meetings with clients. We give them an opportunity to see this is what we do. Let's understand what you're trying to achieve. Let's sit down and talk at length about it for 1 or 2 or 3 minutes. And if it's a great fit, great. Here's what we do to put it in place. But we don't charge clients up front for meetings because we don't think that's fair in giving us a good chance to understand what you're trying to achieve and vice versa. Hope that's helpful. Any other questions? Cool.
Is there fees where like you decide to pull out?
No. Across the industry, like we don't charge exit fees, in short. I encourage a lot of my clients to spend their money if they've got, if they've built up a good sized pot, then we want to encourage them to use that part of capital. Appreciate this is kind of about building towards a certain point, but lots on the other side are starting to spend, and they're topping the super up by X amount. So no, it's not very fair. Anything else? Okay, I'll just jump over into this, which is so got about 5 minutes left. I can race through that in 5 minutes. This is what we call our retirement planning software. We bought this about 8 or 9 years ago, maybe more. So it's ours. It helps us to visualize, to create a financial plan for a client who is, in this case, actually we'll go to this one. In this case, we've got a couple named Pookie and Cully. That was about as creative as I could get. We've captured their ages, we've captured their risk profiles, we've captured, when do you want to retire? When do you want to make work optional? That's a big question you should all kind of think a little bit about. What are their incomes? So Pookie is earning 164 and Cully is earning a small amount of casual cash jobs perhaps. And then what we do is we come up with, you'll see here annually, this 81,000 here. In some cases, we work through a bit of a budget and say, well, what is a good year in retirement going to cost you? Because that's what this is all about, right? You don't want to end up living off rice and beans from day one. So we worked out roughly they live off about 81,000 a year. That'd be a nice retirement income for them. And as a rule of thumb, this is a helpful thing to take away.
How do you allow for inflation?
We bake that in as well. So that net, that 97,000 below is it's inflation being baked in. Good question. As a good rule of thumb, what do you take home now to pay as a household? Typically, 70% of that is what you'll spend each year in retirement. So if you're earning 100 grand in the hand as a household, typically clients would spend, and Kiwis will spend about 60 to 70% of that per year in retirement. Now you're probably thinking, oh, look, we'd blow that in the first week and a half on flights to Vegas or cruises or whatever. And you might, but we're talking about 25-year retirement here. Often the first 5 years is expensive. Then you've bought all the toys and you've done all the travel, the life becomes a lot cheaper and health becomes a greater share of the cost later in life. So obviously including superannuation for this couple, it means that, without super, they'd have to build a pot of $2.2 million to cover themselves for 25 years in retirement at 81 grand a year, inflation adjusted. They're probably going to get super. Probably not going to change in a short, it's not going to turn around quickly. So we've established a wealth target for them. And here, this is where we can think about, well, how much do you have in KiwiSaver? How much are you contributing? Pookie is putting in 10% of their salary. That's great. And Kelly might be self-employed, might not be working. It's still just putting in enough to get them government's money, which is an easy one. That's a 50% return. Then we might factor in a bit of a mortgage calculator and think about, well, how much equity do you have in your home? Do you think you'd ever sell the big empty nest once the kids are gone? Free up a bit of extra money? Maybe not. maybe are paying down a home loan as well. So we bring in property as well, because often there's a lot of equity in clients' property. They might have regular savings. Some people are really disciplined, put away $200 a week, every week, or what have you. And all that helps. They might come into money through a pension scheme, through a inheritance, through shares, selling shares in a business, what have you. And they might have, in this case, they're fortunate they've started with a relatively large chunk in term deposits. So we can work through, well, as a draft, what does a good looking investment portfolio look like based on their risk profile, their time frame, their spending needs? What might it look like in a bull market? If we go back over history and say, well, this is historic market data, what might that have started with? Say they've started with 463,000, and by the end of it, they've almost doubled it over a 4-year, 5-year period. So we can go back in time and say, look, if we use this type of portfolio, what would a GFC do to it? How would that make you feel? Because this is a long-term journey. We want to get clients from the start, not through this end, but we want to get them all right here, and have them fully funding their retirement. So stressing them out like this is important, because this is where the rubber meets the road, and we are eventually a tech crash, as an example, might shake them, and we want our clients to stay invested and enjoy that growth for many years. Lastly, this is where it all kind of comes together. So as a recap, taking this client with this, we've estimated that at age 65, they want about 81 grand a year. Super is going to be part of that, of course. Apparently they're conservative investors. That was their $1.2 million wealth target. Starting here at 466. We're going to close that gap. But without knowing what the target is, and without kind of working out where we are right now, then we're kind of at a loss as to where we need to get to. If they fall short of this wealth target, then we might have to, I might say, look, you've got to save more. If you want to enjoy retirement, then you've got to crank up your savings and Kiwi saver, maybe it's something different. Or you might be forced to retire a little bit late. Or you might be forced to ask your boss for a massive pay rise, but that might be, or you might have to start buying lottery tickets because, So anyway, having a picture of the end, having a start point now is a really good start in helping to understand what we need to do to close that gap. On the other side, I'll just skip through all this to save us a bit of time, but we might imagine that this client has now built up a pot of, say, $1 million, and they've just handed in their notice, and this client wants to spend about 65 grand a year because we work through a budget. How can we make that money last, or how can we make that money outlive the client? Because nobody wants to run out of money before they run out of life. So if we are sensible, we invest that money, and we also provide that regular income to them, like clockwork, then we're helping them to achieve, pretty comfortable retirement, and making sure their money doesn't erode too quickly. And you can have conversations at that point about saying, well, actually, if your money's going to last well longer than you are, why don't you live a little bit more? And that's a really fun part about my job, is often saying to clients, well, you've worked hard, you've done the right things, you've built up a massive pot. Now, how are you going to go and really enjoy it? Whether that's being on boats and cruises or Vegas trips, or whether that's helping kids out with first home deposits, or helping grandkids out with, tertiary fees, or whatever it might be, school fees. So that's a bit of a crash course in the interests of time, but this is how we genuinely think about retirement planning, and how underneath it all, there is an investment vehicle that helps to drive that money further and longer.
Does your calculator there, if you wanted to see your kids enjoy a bit of money, say you had 100,000, you give them some money. Is that built into that calculator as well?
Yep. So that's a great question.
Sometimes it's probably nicer to see them enjoy it while you're alive than
What I this is one of my clients in the city, and she sold an investment property. She had about 750 grand after clearing all her debt. She's lucky. She wants to replace her Mini Cooper with a new Mini Cooper. I don't know how much this is going to cost, but probably not very lot. She wants to renovate her kitchen. Those are important things to her. And so that's not a long-term goal. That's next year. So what we're doing is we're saying well, probably going to cost about 150 grand. Let's put that 150 grand into a cash portfolio that we run, which kind of keeps that money safe. It means that if investment markets do that the day before she's going to take that money out, it doesn't matter. That money kept in cash. It's protecting that goal of hers. But at the same time, if we said to her, she said, "Oh look, I'm not going to need all that money. My kids are, they're settled up with a massive mortgage." Well, why don't we add a kids help goal, and we will cut off 50 grand from each, so it's 100 grand, and we'll do that in 3 years. Is it going to leave her? Is she going to run out of money because of that? Well, probably not. We can also run through some different market scenarios, right? Because we know what markets do over the long run, but different markets will deliver a different outcome. We can't predict the future. We don't have no crystal ball, but we can show them a number of different real market scenarios, which include a GFC right here as an example. What is the likelihood that you can ever achieve those goals, whether it's an income through retirement, it's growth for the next generation, whether it's money soon for kids. And this bakes in fees, bakes in inflation. So it'd be your point. An 80 grand income today would be useless to someone, the same person in 15 years' time. It'd be worth half as much, maybe more. So it's relatively sophisticated software, but at the end of the day, it's helping to create a good start point and a good plan around what's possible. And if I do need to change things, let's do it now. That was a long-winded answer to your question.
Thank you, Reid.
Any other any more questions? Nothing from our online caller. Okay. Well, we've taken up a full hour, and so I suppose we can.
Yeah, we can wrap it up there. We can all have a drink.
Yeah.
If you want to stick around, ask Reid, Wendy, and Mark further questions. So we'll be here. But thank you very much, guys, for your time this afternoon. I really enjoyed the market insights thing, Mark. And I took from Wendy, to eat well and sleep well.
I like that, yeah.
We need to sort of plan ahead. So Reid's wealth plan is a fantastic start. So
thank you very much. If there's any, come up to us afterwards if you've got any questions. We'll be here all night.